Well, we got a few different articles that we've taken a look at, and I'll start us off this time with looking at something I saw come through Forbes, and it was about the title of the article. Let me see if I can find the title here. It was about California state taxes for small businesses, and it said, "Now California can assess taxes no matter where you live." Really, that was the title of the article, and they had an example case in there of a small business. It was actually a screenwriter who made money by providing the services, presumably of screenwriting. The screenwriter doesn't even live in California. The screenwriter lives in Arizona, and was providing services, I guess, across the country. I don't know why. It seems like most of your screenwriting probably would go to places in California, but the article inferred that not all of this writer's income was from companies or customers in California, but that there was a piece of it that logically was from California, and so the issue in the article was, okay, well, if you're sitting in Arizona providing services while sitting in Arizona, and you happen to have some customers in California, does that now mean you have to file a California tax return? And the answer, according to California, is yes. And I've heard this story before. The way this author talked about in the Forbes article was about he used the term that the taxpayer had a unitary business with exposure in California. But the other term that I've heard before, which came about in California, basically has been doing this now for a few years, which attacked service providers just like this, is the concept of economic nexus.
Yeah.
And that concept was that even if you are not physically located in California, you don't set foot there. If you provide services and the economic beneficiary, the benefit of the work that you do is in California, then California claims that you are subject to their tax system. And that was they didn't use that term economic nexus in this article, but that was exactly the issue here, was that this person they were talking about in Arizona, they took it to court. They took it to the California state courts and lost. The California state courts agreed with the California Department of Revenue that in fact they were subject to California tax under California laws. And so, yeah, I mean, that's pretty, that has a pretty broad brush, in terms of people and taxpayers who potentially California could go after, under that theory anywhere where they're providing services and the ultimate customer who's getting the benefit is in California. That's the standard. That's the new standard for them.
Well, I was kind of surprised. Excuse me. I was kind of surprised to hear the word unitary. Is that right? Unitary.
Yep.
And I was wondering. I had never heard. I've performed tax preparation before, and I had never heard that term used. Is that something that's commonly used in the tax law?
Not familiar with that either.
Yeah, it's. I think that the context of it didn't exactly fit the key issue in the article. It may have, in fact, also been an issue. I think that it was an issue. There was one sentence in the article that made reference to the fact that the taxpayer now had to apportion their income to California. So there's kind of a different issue here. There's one question as to, are you taxable at all in California? That's one question. The secondary question is, okay, how do you determine the tax base that's in California? Now, and this is kind of a statewide. You could ask this question on state taxation anywhere, right? State income taxation. How do you determine your tax base in a particular state if you are a multi-state business that actually has income everywhere, right? How do you determine what piece is California? What might seem obvious to the layman is, well, can't you just know how much business you did in California? Well, no, actually. There's different theoretical ways to do this. And if you actually did just know, if you actually were able to say, here's the amount of sales that I had exactly in California, and here's all the expenses that were specifically and only related to California, if you were able to actually do that theoretically, the term we would use for that is allocation. We would say you were doing a direct allocation of some of your income to the state of California. These concepts actually apply in international taxation as well. We could be talking about the difference between income in the UK or income in the US as well in some cases. But what doesn't necessarily apply in international taxation is that the states in the United States have adopted this idea of apportionment, which is a different way of determining the tax base. It's not an actual allocation. So I would presume that your average layperson on the street, your average entrepreneur who's thinking about their state income taxation, probably assumes that it's some kind of allocation methodology that you're able to determine your income actually in California. But in fact, in a lot of cases, you don't get to do it that way. You have to apportion it, which means what you do is you take all of your income from the entire country, and you multiply it by a formula that is based on the amount of sales you have in California to total sales you have everywhere, and that's an apportionment formula. So you're basically saying we're assuming that if we take a percentage on related to something like sales or the amount of property you have in a state or the amount of payroll you have in the state, those are three common apportionment factors. We're assuming that if you have those, if you can derive a percentage from those factors in some way under the state's law, that percentage multiplied by your total nationwide income is a fair representation of your income in California or in some state. And so that concept of apportionment is not just a California concept, it's used across different states, but what can be different is how they actually do the apportionment formula. So that's where this unitary concept usually comes in. The term unitary really usually comes to the question of should you be doing usually comes to the question of can you actually do an allocation or should you be doing an apportionment? And if you're unitary, then you have to do an apportionment because basically they're saying you can't allocate. You really can't figure out how much income is just to California. So using a formula is the only decent thing to do, right? And so that's usually where you get this concept of are you unitary such that you have to apportion? You can't just allocate and say, I have California only income. And so I think that was kind of embedded in this article, but they didn't talk about that in very much detail. They just said he was determined to be unitary, therefore he probably has to apportion. That's all they said about that.
And then I think they gave a little, like a layman's definition. He kind of, threw us that aren't tax professionals a bone.
Yeah.
And kind of broke down layman terms what unitary then meant.
Yeah, and I think there was a statement somewhere in there, an inference that most businesses end up being unitary, and that's my experience as well. That it's hard to get to a point where you're not unitary.
Yeah.
Where your total nationwide business is not interrelated. That you can't you're not in a position in most cases to say, I know that my California operations are completely distinct from all my other operations. If that were true, if you could say that, then you would say, oh, it's non-unitary, theoretically.
Well, it makes sense because the states have so many different ways of defining what constitutes nexus in each of those states, and so having an approach that allows you to apportion them makes sense.
Yeah, yeah. So really, bottom line, I think the unitary discussion in the article kind of takes the discussion in a different direction than really what the title was getting at, which is, in my mind, more of the economic nexus discussion, which is, you actually are taxable. How you calculate the income and the tax there is a second level discussion, but the first level discussion is, are you even taxable there? And if you have what they consider to be economic nexus, because the beneficiary of your services is located in California, you'll be taxable there.
And the biggest question in my mind, and I think the author, he kind of hinted at, ways to determine whether or not you're taxable by California based on some of those, tax cases that he was referencing. But what I didn't get out of him was things that ordinary businesses, for instance, thinking about the screenwriter, how is he supposed to know that the people that he's writing the screenplay for are in California? And what then would trigger him to then take a look at that nexus kind of equation to know that he should file a tax return?
That's a great question. And I think, sometimes in taxation we have these things that we say we use kind of a counterintuitive statement for that. We say they're questions of fact. And when we say they're questions of fact, what we really mean is there's a factual answer to this, but nobody knows what that answer is, right? So it's like, the truth is there is a beneficiary, and there is certain people who either are or aren't beneficiaries in California, but you can fairly state that determining whether the beneficiary is in California or not, and who those people are that are in California, the beneficiaries, that may be very difficult, if not entirely impractical to do. And so we'd say, well, those are questions of facts. The facts are, if you had some way to determine them, the facts, there's a factual answer, but they're just very difficult to determine. And we see something similar on that between the states and also on an international scale often with like software, because what happens in the software scenario is if you're a software vendor and maybe you have a large multinational company that buys your software, and then you ask, where is the economic nexus to the use of that software? I had a client one time that was selling software into Germany, into a company in Germany that was where the headquarters were in Germany, but the actual use of that software was most likely employees that they had in the United States. So the contracts and everything were signed in Germany. The whole transaction was consummated in Germany. So yeah, do they have economic nexus in the United States for the use of that software or not? Could be a question when you're looking at when you're looking at the nature of those questions. And I would say again, it's sometimes the facts are hard or impractical to actually even determine, but they theoretically exist.
Well, because the same kind of scenario is running through my head. This guy's in Arizona. Somebody approaches him to write this script. They could have been in Arizona with him. You know, he writes a script for him. They pay him the amount of money. They could even be shooting the movie in Arizona. But because the script is the basis for the film, and the film will be distributed and the revenue will go back to that California company.
Yes. Yeah.
Then, trickle down that's actually where the nexus was in California for that script. Even though he may not be aware that the company that he wrote and he was on set for the film, was a California company.
Yeah, I think that's a great analysis of the kinds of questions that come up. What I can't tell you is I don't know if that question has been resolved by the California Franchise Tax Board or the California courts. Not being a full-on California expert myself, I would kind of pause there and say that's a great theoretical question. It may or may not have an answer in California tax law.
Yeah, so the thing that I was thinking about is just that different states are going to have different answers as to what defines your nexus. And so I can imagine two states being involved in a multi-state transaction where they don't agree. Both states deem that you have nexus in that place. And so I would wonder how that would get resolved.
Yeah, that is I don't know. I think that is a potential problem. There's been work. What I know is that there's been kind of conferences among the states to try to resolve that from happening. But ultimately, that would be Congress's job to regulate interstate commerce and ensure that's a highly unlikely scenario. And I think that the concept of using economic nexus is relatively new. So what I don't know is if there's been any work to resolve the possibility of two states trying to get the same income because of the economic nexus rules. I think a lot of times for really small taxpayers, that's less of an issue because the two states in question are like the state that happens to be their home state and the other state that is trying to claim that they have income there. And there's usually a process for when you're just talking between two states, the state where a business, it's his home state, its state of residence or domicile, and you're talking about the state that another state that it does business in. Usually they have state tax credits where they create a system that on one of the state tax returns they take a credit for the tax that's being paid to the other state. And so when it's just the two states like that, then I think they've got a mechanism to work that out mostly through that system, but I can see where it can get a lot more complicated if you're dealing with many different states and you have two or more that are claiming the same income. I don't know if the credit system would fully work that out or not.
That makes sense.